Hey guys, welcome to the early release of the Foundation Course 2.0. Thank you for taking some time out of your day to join me. If you guys are brand new, my name is Akil Stokes. I'm a Forex trader. I'm a trading coach. I'm also one of the co-founders at tier1trading.com. And I just love doing live events like this. Do me a favor, if you guys are pumped to be here, on the count of three, I want you to enter a yes in the chat box to your right. 1, 2, 3. I love when it all floods in like that, but seriously, I do appreciate you guys being here. You guys are going to give me a massive amount of feedback that are going to allow me to make this course the best that it can possibly be. Now, if you guys are new to me, I'll give you a brief introduction, right? Before consistently profitably trading, before managing money, before going on to coach traders, I was very similar to you. I was a consistently struggling trader, consistently blowing money in the markets to the point where I blew about $30,000 in basically a month. And I learned a lot of lessons. I have no regrets about my trading journey because I learned a lot of lessons that have made me the trader I am today and that allow me to be the coach that I am today as well. But one of the biggest lessons that I learned was I was too caught up focusing on the what to trade and not the how to trade, right? Let me ask you guys this question. How many of you have ever felt like all you want to do is find that magic strategy, right? Give me a yes in the chat box. I know I've been there. I spent years and years and years trying to find that magic strategy, and guess what? It never really worked. And after a really down period in my life and in my trading, I realized that if I wanted to make a difference in my results, I need to stop focusing on what to trade and really focus on how to trade. Just the art of reading a price chart, the art of understanding technical analysis. And for me, the way that I learn best is by creating a story, right? So you fast forward years later when we started Tier 1 trading, I decided to take a big risk and put out a brand new course focusing on the foundational elements of technical analysis, but teaching it in a way that was a little bit different. Instead of just teaching you, hey, this is what this is what that is, I wanted to teach you more of a understanding of what you're looking at. Not just, hey, this is a candlestick formation, but why does this candlestick formation form? How does it form? And really the importance of understanding what you're actually looking at on the chart, right? The why and the how instead of just the what. And I wasn't sure if it would go over well, but lo and behold, it has by far been the most popular course that I've ever done. And what that did was it got me excited about doing the second phase of it, which is what I'm going to preview to you guys here. Now, in this course, my goal is to take a macro look at how to trade. I think we complicate trading a little bit too much when there are really a handful of foundational elements that you need to know. And no matter what type of trader you want to be, trend trader, consolidating trader, moving average trader, Bollinger Band trader, right? No matter what type of trader you want to be, if you can have a grasp and a firm understanding of these general concepts of not only how to trade, but the technical analysis behind how to trade, I think you could be successful in either strategy, either technique, or multiple techniques. And that's really kind of my goal here, to teach traders how to be well-rounded instead of a one-trick pony. Because Lord knows, market conditions change, and if we're not able to change with them, we're going to be out the game pretty quickly. So what I want you guys to do for me here is give me some feedback on this course. My goal is to simplify these concepts as much as possible, but not oversimplify them. And also, I want to make sure what I'm saying makes sense, right? I've been trading for a very long time now, so sometimes what makes perfect sense and is clear inside my head may come out a little bit confusing to you guys. If that's the case, I want you to know. So throughout this presentation, I want you to use that comment section. I promise I will go back through it. I will look at each and every comment. I will respond to them, and I will use that to finish up the rest of this course and make it the best possible course that it can be. So I appreciate you guys in advance. One more thing. This is the second part of a course. It is the Foundation Course 2.0. So if you are brand new, and you don't understand, say, what a pip is or what a candlestick is, It may be a little bit confusing. I think you should still get the concepts, but understand that you're missing a good bulk of foundational knowledge. But for you guys that are typically supporting what I do here on YouTube and have been trading for any amount of time now, you should have an understanding of what we're going to talk about as I preview the first chapter of this course. So I hope you guys enjoy. Remember, leave feedback, leave feedback, leave feedback, and get your notebook ready. Hey guys, welcome to the first section of the Foundation Course 2.0, titled How Markets Move Part 2, There Is No Real Trend. Now, before you get started with this section, I'm going to assume that you've finished the first Foundation course and you've been through all the modules on how we define trend, how we read a price chart. Because what we're going to do in this section is take a deeper look into that. And if you've already been over the basics of extension, retracement, this should make sense. If you haven't, it may be a little bit confusing or a little bit more confusing than it needs to be. So make sure you are fully confident in how to read a price chart, how to identify new structure highs, outside returns, all of that fun stuff before you get started. If you are, then let's dive in. So the question is, why do I get confused? And this was a common issue that we had with a lot of the traders coming through the platform, where yes, they have mastered the skill of reading a price chart. They can draw out the ebbs and flows, on their whiteboard or in their notebook. They can even go into a chart and easily identify trends. However, one of the biggest confusion points that we get is, how do I identify the true trend? Are we bullish? Are we bearish? Are we just bearish within a bullish trend? Are we bullish within a bearish trend? And that confused a lot of true traders because they were looking for the singular true trend. And fact of the matter is, there is no true trend, and that's the reason why you get confused. You are looking for an answer that doesn't actually exist. There's no one trend in the market. The market is made up of many different trends, and it moves in a way in which we call fractals. And fractals essentially just means moves within moves within moves. So a good example of a fractal in real life or nature would be like a snowflake, for example. A snowflake has a very specific pattern, and then when you zoom in, there's a pattern within the pattern, and then as you keep zooming in, there are smaller repeating patterns that make up the bigger pattern in which the snowflake is. And the market is the same way. You may have a longer term bullish trend, and that longer term bullish trend may be putting in a pullback, and within that pullback may be a shorter term bearish trend. But then within that shorter term bearish trend, as you dial down another time frame, maybe an even shorter term bullish trend, and keep going and going and going the further that you go down. Now we're going to touch on this a little bit later, but just to provide you guys with an example of what fractals mean and why it can be so difficult for many traders to really build confidence in what trend they should be looking at. And that brings me to my next point on why do traders get confused is, well, many traders don't perform consistent analysis. And this can go on many levels as far as trading systems and trading strategies. But to start at a very basic level, many traders don't make the habit of looking at the chart on the same time frame each and every day. When we look at the chart and when we define what time frames we are using to, say, identify trends. So, for example, if I say the daily chart is going to be my higher time frame and the 60-minute chart is going to be my lower time frame, what that means is that I'm going to use the daily time frame to get my bird's eye perspective on the market. I'm going to use the daily time frame to determine what the true trend is in the market. And now I'm consistent in using this same time frame to identify the same thing, and I should be able to come up with the same result each and every time. However, if some days I'm going to the daily to define my trend, but then maybe the next day I'm going to the weekly, but then the next day I'm going to the 4-hour and then the 15-minute, I'm looking at different parts of the market. I'm looking at different phases of the quote unquote underlying trend, and I really don't have a consistent view on what's going on. And that's another thing that gets many traders in trouble. They just don't have a consistent, or they just don't take a consistent approach to identifying the market and identifying which time frame they're going to use to pick out their underlying trend. The last point is we always find a need to label. And this is one of those things where we tend to make things more complicated than they need to. One of the things that you guys loved about the Foundation course 1.0, and hopefully you love it about 2.0 as well, is that I took an Akil approach, meaning a very simplified approach to identifying and describing candlestick formations and how they form, identifying and defining trend and how that forms. And I think some people just always need an answer, and for sometimes things can be too simple that it doesn't actually make sense, where it's like, wow, that was too easy, it has to be wrong. And sometimes it's as easy as that. We don't have to overcomplicate things all the time. So if you have the correct process, just follow the process and take the process for what it's worth. Now, before we dig in a little deeper on how price moves, I want to introduce you to Richard Wyckoff, mainly because we're going to be taking a look at some of his theories and opinions on the market. So I do think it's important that you know a little background about him. Richard Wyckoff was an early pioneer in the technical approach to studying the stock market. He was considered one of the 5 titans of technical analysis, along with Dow, Gann, Elliott, and Merrill. Wyckoff was an avid student of the markets, as well as an active tape reader and trader himself. He observed the market activities and campaigns of legendary stock operators of his time, including J.P. Morgan and Jesse Livermore. From his observations and interviews with these big-time traders, Wyckoff codified the best practices of Livermore and others into laws, principles, and techniques of trading methodology, money management, and mental discipline. From his position, Mr. Wyckoff observed numerous retail investors being repeatedly fleeced. Consequently, he dedicated himself to instructing the public about the real rules of the game as played by the large interest, aka smart money. Wyckoff had 2 essential rules when it comes to trading. Now, he has lots of theories, but again, we're not going to dig too much into Wyckoff. I would advise, if that you're interested, feel free to go and do research on your own. It's some very interesting stuff. I know I get nerdy about it. But the first rule of Richard Wyckoff states that the market never behaves the same way. Price action will never create a move in exactly the same way that it did in the past. The market is truly unique. And I say this all the time. I think what confuses a lot of traders about the market is that most of what the market will show you is junk. Most of it is fluff. Most of it is completely random. It has no purpose, aside from confusing you as a trader. How many of you guys have ever been to a magic show? Well, when you go to a magic show, right, what do you see? Is it just a magician on stage that kind of stands there and does the trick? No, there are loud noises and bells and whistles and lasers and smokes and dancing girls and what have you, sometimes live animals. All of that is the fluff. All of that is the confusion. All of that is the randomness, the thing to kind of take your attention here, take your attention there, take your attention everywhere and anywhere but the actual trick that the magician is doing, the little sleight of hand, right? And the markets are the same way. The market only has a number of moves that it makes. It only has really a set number of things that it does. The hard part is the market does it in a slightly different way each time, right? You know, we can go back to what we discussed in the foundation course, the original version, where we talked about how the market moves. Well, the market does three things, right? It goes up, it goes down, it goes sideways, right? Very simple. However, if I brought you guys a chart right now and said, hey, identify this trend for me, it's not as simple to understand, because within that up, there's kind of these mini moves and choppy moves. And within that consolidation, there's mini trends, right? There's a lot of junk that is set to confuse you. But understand that the market is unique. The market does follow the same basic principles. It just gets to that point in a slightly different way each time. Now, the second rule of Richard Wyckoff is related to the first one, and it states that since every price move is unique, its analytical importance comes when compared to the previous price behavior. And I look at this as being a recency bias, in the market. And we're going to get into this in later chapters of this course, but I often get asked the question, Nikhil, what levels of structure are most important? I was heard that I should count the levels of structure that hit a certain point 5 times. I should look for all-time highs, all-time lows, right? I was heard that I should look for the structure that happened in the beginning of the year. For me, it's all about recency bias. What has the market recently done? Whatever the market has recently done is the most important thing for the market for me. I'm not discounting stuff that has happened in the past, right? I'm sure something that happened a year ago could be important, but what's more important is what has recently happened. What previous level of support has been broken? What previous level of resistance has held, right? Those are the most important things. And I think we should have that type of recency bias when we're looking at a chart. Now, on to our next point. Wyckoff had a 5-step approach when observing the markets. Now, this was mainly related to the stock market. If you are a student of technical analysis, you know that technical analysis, the general principles work the same in every market. So whether you're looking at this from whether you're in crypto or Forex, maybe not crypto. Crypto is a little wild, at least at the time of recording this in 2019. But if you look at the stock market, if you look at commodities, if you look at the Forex market, the general principles of technical analysis, they're all the same. Now, each market is a little bit unique. The stock market has some unique features in comparison to the Forex market. For example, the stock market is traditionally a trendy market, right? It is a trendy market based on the bigger indexes. The Forex market, on the other hand, is typically a market that tends to consolidate because it's more of a head-to-head battle. But with that being said, support is support, supply is supply, demand is demand, uptrends are uptrends, downtrends are downtrends. They're all the same. So this 5-step approach certainly works on any market that you will look at. But the first step is determine the present position and probable future trend of the market. And this is basically looking at the chart. What has price done? What is price doing? What is price likely to do next? Step 2 is select stocks in harmony with the trend. So if you're identifying a bullish trend, look for stocks or look for moves that are in line with that initial analysis, right? You have identified that the market is bullish. Look for bullish opportunities. Look for opportunities that involve yourself with the harmony or the underlying trend. Number 3 is select stocks with a cause that equals or exceeds your minimum objective. Now, this is important because many new traders trade just to trade, right? It's one thing to find a trading opportunity. You need to do that first and foremost. But what's also important, and may even be more important, is that you find an opportunity that has legs, meaning that not only do you identify, let's say, the overall direction of the market, not only do you identify a stock or an opportunity that will involve yourself in that move, but there has to be a big enough objective to shoot for. So if you only project the market to go a little bit up, is it worth being involved in that trade? No, right? Because there's not really enough profit to be made, especially when compared to your risk, perhaps. So you need to identify an opportunity where you look at the chart and you say, hey, the market has an opportunity to go here. This is certainly a profitable opportunity. The opportunity to shoot for this profit is well worth the risk I would have to take on if I was wrong. So you got to make sure the market has legs and actually room to go where you think it's going to go. Number 4, determine the stock's readiness to move. Is what I'm seeing on the price chart in a position that we are ready to go? Or do I need to wait until we get a certain level before I should be involved? And this is basically saying, do I need to be involved in the market right now? Is this thing ready to turn around? Or could it potentially turn around, but I need to wait for a lower move or something like that? Last is time your commitment with the turn in the stock market index. This one's a little bit more stock related. I'm not a big fan of correlations, especially in the Forex market. And the stock market is a little bit different because individual stocks tend to move with the bigger indexes. So it's basically looking for correlations in the market. Now, what we've done here at Tier 1 Trading is we've essentially taken Wyckoff's 5-step approach and we've broken it down into our own approach, which we call IPDE. And this was an approach that I was taught by my mentor, Jason Stapleton and Todd Brown. It is something that is the foundation of my trading. It is really the backbone of everything I do in the market. It is the process of how I analyze and how I find quality trading opportunities. And the first step is identify. And the question that we need to ask ourselves is, where is the market currently and what has it done previously? And we'll dig into all these in details as we go on to actually look at charts and trading opportunities. But what has the market done? What is the market doing? Are we sitting at structure? Are we breaking structure? Have we broken structure? Identify what we're doing. Are we bullish? Are we bearish? Are we in consolidation? Basically asking yourself the question, what type of market state are we in? Because if you don't know what type of market state you're in, you can't go on to step number 2, which is predict. Being able to identify what the market has done and what the market is doing allows us to make a prediction on what is likely to happen next. And this prediction process has 3 steps. What is the market likely to do next? Is it likely to go up or down? Where is the market likely to go next? So that's that projection of we're likely to go this far up or this far down. And then how is the market likely to get there? Are we likely to go straight up? Are we likely to retest? 3-step prediction process. Again, what is the market likely to do? Where is the market likely to go? How is the market likely to get there? What, where, how? What, where, how? That's our prediction process. Step number 3 is decide. Now that we've identified what the market is doing, now that we've predicted what we think the market is likely to do next, now we need to decide, how are we going to attack this situation? Meaning, is there a way for me to get involved? If there is a way for me to get involved, then what do I need to happen in order to get involved? And this goes from everything from trade entry to really the whole EST process, entry, stops, and targets. What do I need to enter the trade? Or where does price action have to go to enter the trade? Once I enter the trade, where do protective stops need to go? Basically, where do I know I'm wrong at? And where do I project price to go to for targets? Where do I know I'm right at? Lastly, step number 4 seems very simple, but if you ask many, it's a very difficult part. Execute. Push the damn button. Execute the trade. And again, it's simple. This is basically, once price meets your rules of engagement, involve yourself in the trade. But this is where trading psychology comes in hand, where a lot of people will see price doing what they need to do. They'll get scared, they'll get nervous, and they won't actually push the trigger. So although I joke and kid and say it's a very simple part of the process, just take the trade, push the damn button, it is very hard from a psychological standpoint, and that needs to be understood. So now that we've gone through the process of what it really takes to analyze a market, let's get back to the technical somewhat and take a look at Wyckoff's market cycle theory. Wyckoff broke market movement, price movement up into 4 phases, and I'll show you an example in a little bit. But the first phase is an accumulation phase, and this is essentially caused by an increase in institutional demand, right? Buying, buying, buying. Think about it as a range-bound situation. Phase number 2 is markup. This is where the buyers gain enough power to push through the range. We see a breakout from that range. Distribution, this is when sellers are attempting to regain control of the markets. And then there's a markdown phase where sellers have gained enough power to push price down. And it's a very simple process. And as you can see in front of you, accumulation is basically your sideways ranging movement. Your markup is your uptrend. Your distribution is, once again, your consolidation. And your markdown is your downtrend. Now, very, very simple when you look at this on this, this remedial, very basic drawing. However, we know, right, because I talked to you guys about fractals earlier, we know that in real life, the markets actually don't look this smooth. So in real life, it may look something like this, where you have an accumulation and then you have a multiple-legged markup. For you guys that are Elliott wave enthusiasts, you guys should understand this. And then it goes straight into distribution, which looks like consolidation. And at the time, you probably think distribution is simply part of an uptrend. And then we have the markdown, which again is another multi-legged move. Now, there are certain aspects and little clues to look for within each of these phases that will give you a slight edge, telling you that this is more likely to happen than that. And we'll take a look at that later. But I just want to show you that what happens in real life is a lot different than what happens in a book image or a Google search image. And what's key in trading is not only do you become familiar with the basic principles, but you train your eyes, you train your RAS, your reticular activating system, to be able to identify and break down these type of opportunities in the market. So previously in the course, we talked about the importance of consistency, the importance of having a process, and it really is key in trading. We always preach that you should treat trading like a business because, well, it is. And if you look at any successful business out there, whether how large or how small, there is a process for how they run their business. There are guidelines for what they do, when they do it, how they do it. And that's what allows them to see consistent success in the long run. And your trading should be no different, right? You need to determine your process and stick to it. And I put emphasis on your process because there are so many ways to trade. There are so many ways to be profitable. And if you've spent any amount of time on the internet, you've probably seen them. You've seen moving average strategies, you've seen strategies with 4 or 5 different indicators, you've seen plain price action strategies, structure-based strategies, trend continuation strategies, counter trend strategies, you name it. And something that a newer trader gets caught up on is which strategy is the best, which strategy is the one that works. And the truth of the matter is, all of them work. And success in trading isn't really based off of the strategy, it's based off of you, the trader. So once you determine your process and your trading style, it's important to ignore what everyone else is doing, is from a perspective of doubting yourself. It's always okay to Be curious, right? Curiosity allows us to ask questions. When we ask questions, we get answers. When we get answers, we find a way to improve or at least increase our knowledge. But we don't want to be in the position where we're bouncing from strategy to strategy, or really thinking because this trader trades this way and he's got this many followers, but I trade this way, that my way of trading is wrong. So consistency is key. Stick to your process. Now, the process that I have, or I guess we can say the formula that I have to success, is pretty simple. Consistent analysis plus consistent execution equals consistent results, right? I'll say it one more time for you guys that are a little bit slower. Consistent analysis plus consistent execution equals consistent results. And this means that if you let's take a step backwards first. This is all assuming that you've gone through the process the right way. You have learned how to trade, right? You have gone through the strategy develop section where you've developed your own strategy, or maybe you've taken a strategy that we've taught you here at Tier 1, used it as is, or made your tweaks to it to reflect your personality. And that's stuff that we'll get in later on in the trade plan development course and the strategy development course. But assuming you've done that, you've back tested it, and it has a positive expectancy, meaning that what you're doing works. This is the formula that will allow you to have long-term success, right? Consistent analysis means that you're looking at the charts the same way each time. You're looking for the same thing in the market each time. When you have a strategy that is tried, true, and tested, something that you believe in, something that you will be trading, you're not looking for everything in the market. This is how traders get that paralysis analysis, right? You're not looking for everything in the market. You're only looking for the specifics of what relates to your style of trading, to your specific strategy. Next is consistent execution. So after you analyze the markets the right way, the chart the right way, you go through that IPDE process of identifying and predicting and deciding, right? The next one is consistently executing the trade, meaning that you're taking the trades you're supposed to take and you're avoiding the trades that you're supposed to avoid. And of course, in the middle, you're not making the psychological mistakes that hold many traders back, meaning you're not moving your stop loss back because you're scared. You're not taking targets too early because you're scared. You're not taking targets too late because you're greedy. You're executing the trade per your plan. And if you do those two things, right, if you look at the market the same way each and every time and you take the trades that you're supposed to take and it's all working within the trade plan that you've created, right, your rules-based strategy, something that is testable, verifiable, repeatable, and has proven to have a positive expectancy, you can expect consistent results. Now, what's important about consistent results is consistent results doesn't mean you win every trade. It doesn't mean you win every day. It doesn't mean you win every week. Shoot. For some of you, it doesn't mean you win every month. But bigger picture, you should have positive results if you're doing everything correctly in your trading in it. And it's very, 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 very important to have confidence in that. So you need to have a process, right? And we talked a little bit about this during the IPDE process: identify, predict, decide, execute. But you're going to see this as a common theme. So we're going to repeat a lot of these viewpoints over and over again. Your first process should be this. And I guess before we get started, understand that the process is going to be slightly different for everyone. We always talk about your trading should match your personality. It should match your philosophy. And as human beings, we are all slightly different. As traders, you're going to find that we are all slightly different as well. So this is not a say-all, be-all. It has to be this exact way, but kind of a bigger picture view of at least the path you should be working on. And the first part of that process is going to your higher time frame. And remember, your higher time frame may be different than someone else's higher time frame. So going to your higher time frame. And your higher time frame is the time frame in which you've chosen to take a bird's eye view of the market to gain perspective. You go to your higher time frame for one reason and one reason only: to identify and predict. And I guess that's 2 reasons. Let's move back on that. You go to your higher time frame for 2 reasons and 2 reasons only: to identify and predict. You want to be able to look at the market with no intentions of trading, so none of that stuff clouding your judgment. That's very important. You want to go to it with a fresh perspective, a clear vision. And you want to ask yourself, what is the market doing? What has the market done? Where is the market at? Right? Are we trending? Are we in a bullish trend? Are we in a bearish trend? Are we in a rotation? Are we in consolidation? Are we at structure? Did we just break structure? Are we in the middle of an impulse leg? What is the market doing? Where is the market trading at? Based off of that information, we can now make our prediction. Okay, well, if the market is doing this, then I can predict that the market is likely to go higher. Then I can predict the market is likely to go lower. Whatever that prediction is. This is all in our higher time frame. We're not thinking about trading yet. There's no question on how can I get involved? How can I do this? It's just, imagine me coming up and asking you the question, hey, Johnny, what do you think the market's going to do on the Euro Dollar Daily? And you're like, I think it'll go up from here. That's all it is. I'm not asking you how you're going to get involved. We don't want to overthink it. Just a general bird's eye view, a general perspective of the market. Because this is going to set up our confirmation bias. Confirmation bias essentially means when you're locked into an idea and all of your future ideas work within the realm of that bigger idea. And it could be a positive or a negative. An example of a negative confirmation bias would be watching the news. This is something I used to do, where I used to watch the news and CNBC and all those pundits, and they'd be like, you gotta buy gold, buy gold, buy gold, buy gold, right? So in my ear all morning, right, all week, it's gotta buy gold, gotta buy gold, gotta buy gold. All of the smart traders out there are buying gold. Therefore, when I load up a price chart and I look at gold, what do you think I'm automatically looking to do? I'm looking to buy. And whether I know it or not, I'm ignoring any reasons for selling. We can have a perfect sell setup based off the technicals on gold, but because I've been sort of brainwashed by these outside sources to buy, I'm ignoring it because I have this bias that I can only be in the market with this one way. We're doing the same thing here, but we're doing it off the technicals. So by the time you leave your higher time frame, you should have a clear idea of what you predict the market is going to do and what direction you can get involved in. Then when you go down to your lower time frame, right, you're working within that general vision. So the first is go to your higher time frame. The second is determine what the overall trend is. We talked about that. That's the identify and prediction part. The third is determine what the short-term trend is. Right? And this is going to be down on your lower time frames where you're looking at, okay, this is the overall trend is bullish, but the short-term trend is also bullish, also bearish. That's the second part of the prediction phase where you're going to be able to tell where the market's at and whether you should be looking to buy or sell. The last part is plan your attack. How am I going to get involved? Can I get bullish in anticipation of this type of move? Do I have to wait for this to happen before I can get bearish? Should I stay out of it? Whatever that reason may be. And this is going to get clearer as we actually look at trading situations down the road, but just a broad sense of having a process each and every time, right? You should have a reason that you go to each of your time frames. Now, many of you guys have become confused over overall trend, short-term trend, long-term trend, short-term trend, whatever you want to call it. And this is something that many of our clients have brought up over the years. We do a private Q&A session each and every Monday where it's a chance for you guys to take what you're learning in the course, bring it to myself, and I put together a training lesson for you. And the training lesson is powerful for 2 reasons. One, it gives us a chance to do some hands-on training with you while you're there. If you're watching the recording, you can kind of watch it live, and we can really dig in deeper than just seeing a PowerPoint slide and just seeing the training lessons on the chart. We can dig into specific situations that may be a little bit funky, right? But it also allows me to see the common issues that traders are having. So if it's a common thing to have a Q&A on traders being confused because of the short-term and long-term trend, then I know it's something that we need to go back and reteach, and it allows us to really know what new course material, such as the Foundation Course 2.0, we should be teaching. So we can take a look at these two different trends, the overall trend or the long-term trend versus the short-term trend. On the left-hand side of your screen is going to be an overall trend, right? This meets our rules. If you guys have taken the foundation course, the first one, you can see that we have our three moves, right? We have our initial structure high, we have our outside return, we have our new structure high. So we have a confirmed bullish trend. And the current move is what? What would you guys say the current move? Again, looking at the left-hand side of your chart, the very last yellow arrow pointing down, the current move is what? It's a potential pullback, right? So it's done nothing to end the trend. It's a natural part of the ebb and flow. We're giving a little bit of relief. We can predict that we're going down to create what would be our potential outside return. And that if we see an extension and a new structure high, then the trend will continue, right? So it's simply a retracement within the bigger bullish trend. Now imagine yourself going down to a smaller time frame. That leg may look a little different. And if you look on the right-hand side of your chart, that's going to be the short-term trend. So what is the market doing recently? Well, the most recent move was a downward move, correct? Yes, we're in an upward trend overall. Yes, this downward move has not violated any part of the upward trend. Yes, we predict it to be only a potential outside return of the bigger trend. But the most recent move that the market has done is it's found an extreme. It's found a period of exhaustion. And now it's moving downward in a bearish trend. So we're looking at the move within the move, essentially. And if we look at another chart here, here's how you would look to trade either trend. So a trader looking to buy, let's start with that. That's the example on your left. You're simply waiting for that pullback to complete, and you're looking to involve yourself in the underlying trend with the next move up. We talked about kill zones when we create our kill zones, which are the zones in which we believe that price is likely to not only go to, but reverse off of. That kill zone is going to be measured from our previous structure high, again here on your left-hand side, to our outside return. So we're anticipating that this outside return, this current move down, is going to complete either at the top of that kill zone or somewhere within that kill zone. And as a trader looking to buy, we're looking for when that outside return is going to complete, when that reversal is going to happen, and when we're going to see the next move up. And hopefully we can find a way to involve ourselves in that move. Now, a trader on the right who's looking to sell is doing the same analysis. They're just looking to catch a different part. So the trader on the right that's looking to sell, they're still viewing this as a longer term bullish trend. Right? We have our initial structure high, we have our outside return, we have our new structure high. Now, the difference is when they look at the current pullback, the move that's highlighted in red, instead of asking themselves the question as a buyer would, where is this pullback likely to complete to so that I can get long? What they've most likely done is they've involved themselves in this move short. And they're still looking for the area in where the pullback is likely to complete. However, instead of looking to buy at that level, well, let's take that back because they are looking to buy without making it confusing. But instead of looking to involve themselves in the next move up, they're looking at that area as being an area where they can get out of their bearish trade, where they can take some profits and then wait for the next opportunity to get short. And this is a good example of the difference between trend continuation traders on your left, looking to be involved in the underlying move of the trend, and counter trend traders on your right, looking to be involved in the outside returns or the period of relief in the trend. And if you notice, no matter what type of trader you are, the analysis is exactly the same. You're still identifying what the underlying trend is. You're still identifying your kill zone. The only difference is one, you're waiting for the reversal in that kill zone to get long, or two, you're waiting for the reversal to get to that kill zone so you could take profits off of your short. But the same analysis is done. It's just you're looking to involve yourself in a different way. Now, let's talk a little bit about the trend within a trend, because I know it may be a little bit confusing for you guys. On the right-hand side, you just see a straight red line. And although we're not talking about actually trading yet, many of you guys are saying, well, Keo, how can you ever catch a trade there? Well, on the lower time frame, right, those moves down or those moves up aren't going to look as smooth as they do here. I think if you've ever looked at a price chart, you'll understand that. The market just doesn't give you a nice smooth move up or a nice smooth move down. It typically ebbs and flows, right? You get movement that looks like this within each of the moves. That's the whole fractal thing that we talked about earlier. So if we take a look within that current outside return, that red arrow that's in our pullback on the left-hand side of your screen, what it may look like on a lower time frame is what you see on the right. It may be a full-blown bearish trend on the right. And that's what I mean by you can look to either catch the long-term trend, you can look to catch the short-term trend, because the market moves in fractals. But what's important, no matter what type of trader you want to be, is that you understand the market conditions, the overall market conditions, because it's going to help with profits. It's going to help with stops. Again, if you're looking at this on a lower time frame and you know that price action is coming down to a place where on the higher time frame it might be a reversal in the underlying trend, you want to be out at that position. You don't want to get greedy and hold any type of profits too long and have the market reverse and stop you out. So you need to know what type of trade you're in. So you need to look at this and say, okay, although I am in a short-term trend continuation trade, because I am involved in the direction of the short-term trend, that bearish move, I understand that this short-term trend is simply a pullback within the bigger trend. And again, I hope you guys aren't confused. If you've taken your time through the first course, this should make perfect sense because you've learned about pullbacks and whatnot. If not, I really encourage you to go back to that first course and go through that content again. But of course, things will get easier as we actually go over to the price charts and take a look at kind of a practical example. So the question of, Akil, what is the true trend? Whenever I get this question, my answer is there is no true trend. All that exists is your interpretation of the trend, and that's based on how you view the markets. It's based on the time frames which you're looking at. What is your higher time frame? What is your lower time frame? And how you're looking to get involved in the market. And I understand that we can never eliminate the words bullish trend or bearish trend, nor should we, from trading. But again, it is really, 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 really important that we understand that everything works in fractals, right? The snowflake I told you about. There's no one trend. There's one trend that fits within a bigger trend, which fits inside a bigger trend, which fits inside a bigger trend. And it's always going to be like that. In order to stop that confusion and get that paralysis by analysis and saying, oh, we're bullish, but we're bearish inside bullish, and we're bullish inside bearish, and head explosion. What stops that is having a process. Understanding that I use this specific time frame to identify my higher time frame trend, to identify my underlying trend. Once I identify my underlying trend, then I can go down to the lower time frame, look at the smaller trends that exist inside the bigger trends, and understand where they fall in the bigger scheme of things. So I hope that makes sense. If there's one thing you can obviously you can go back and rewatch this section as many times as you want, but I hope the one thing that you grab from this training is that it's all about the process, and that process is custom fit to you as the trader. All right, traders, welcome back. In this video, we're going to do some practical application. And what that means is we're going to take a glance at the chart and try to relate it to what we just looked at in the previous presentation. Now, in this practical example, we're going to just focus on trends. So looking at bigger trend versus smaller trend, underlying trend versus short-term trend, long-term trend, short-term trend, whatever you want to call it. We want to focus on being able to recognize which is which. And I say that because I don't want you guys to worry about how do I trade it? How can I get long? How can I get short? We will visit that in later videos. For right now, we're just working on the identification. So I want to start off by asking you guys this, and this should be a direct follow-up on what you learned in the first foundation course, but what type of trend are we in? Are we bullish? Are we bearish? Are we in consolidation? Do you not know? What type of trend are we in? If you said bearish, we are correct, right? If we look at this point right here, this is going to be our initial starting point. This is going to be our initial swing high to swing low. So we have our starting point to our initial structure low. We then have our outside return. We then have our new structure low, giving us that 3-point move, confirming our trend. We then have another outside return, followed by another new structure low. So again, price action is making a series of lower highs and lower lows. All signs of us being in a bearish trend. So the underlying trend here, let's say the daily was our higher time frame. When we look at this price chart from the higher time frame perspective, we can say that the underlying trend is bearish. However, when we go down to a lower time frame, we may have a different view of things, and that's where a lot of traders get confused. A lot of traders don't have a set time frame that they look at. They try to base their opinion off of whatever time frame they see at the moment. And when you go down to a lower time frame, moves can look a lot different. So if we simply highlight our outside returns, I'm going to make this different. We'll make this a different color. We'll make this yellow. If we were to highlight our outside returns here on this chart, it's pretty obviously that these are outside returns. However, because they made moves, right, from a low to a high, we can also make the case that these are short-term bullish trends. Now, let's just jump to a 60-minute real quick, and let's see if I can get these dates and times right. February, okay. Should have had the little deal on here where I link my charts, but why would I think before recording? We'll do that in the next version. But let's go back to February here, right? And we can take a look at February, and we can take a look at this move right here. Now, if I were to ask you the same question, a little bit choppy here, but in general, if I were to ask you the same question about the current trend on the chart, what would you guys say? Well, many of you would probably say bearish. Now there's a lot of, bullish. Now there's a lot of consolidation here. It's not the cleanest move in the world. However, we can see that price has been moving from the bottom left of our chart to the top right. And that's one of the things that we look for in a bullish move. And even if we were to take a very broad look at our swings here, swing low to swing high, outside return, new structure high, right? This is a lot of consolidation, but we never really break our outside return, right? We are continuing to make higher highs and higher lows. So a trader that maybe just came to the 60-minute chart for the first time, they may look at this and say, hey, you know what? Bullish trend, let's get long, let's get long, let's get long. However, when we look at this from a higher time frame perspective, this entire bullish move, the one I just showed you on the previous chart, all that is our zone right here. So the short-term trend is bullish, but it's only a bullish move within the bigger trend, which is bearish. So think about it like this. The bigger trend is bearish. We're currently in an outside return, a retracement, a pullback of that bearish trend. Obviously, if we're going to create a pullback will go against the trend, which means it'll be a smaller trend on a lower time frame. But the bigger move is still bearish. The bigger move is still bearish, and that's going to be important to know later on when we're talking about stops and targets, and in many cases even entries, depending on what type of trader you are. Let's look at another example next. So once again, in this example, we're going to be looking at a bearish trend. This time I'm on the New Zealand dollar daily chart. And once again, a clear bearish move. I'll go ahead and draw it out. We have our starting point right here, swing high to swing low, followed by our outside return, followed by our new structure low. We have our outside return. We have our new structure low, outside return, new structure low. It looks like we can probably measure this on. I'm not going to be too exact here just for training purposes, but outside return, new structure low, and then what we think is an outside return before eventually being violated, right? So aside from the violation at the very end, this was a clearly defined bearish move on the daily. Now, once you go down to a lower time frame, let's see if these moves just isolated, right? If we isolate the pullbacks, let's see if this gives us a different perspective on the market. So we'll measure those out right here. And then let's go down to, say, a 60-minute chart once again. That's a good enough way to go. 60-minute chart. Let's get rid of some of the trades that we're involved in. So if we go down to some of the moves that we looked at on the higher time frame and look at them down here in the 60, you can see we have a slightly different story. Now we'll start with our last one here on the right, and you can see that this area right here, which was simply an outside return of the bigger bearish trend, is a full-blown bullish trend in itself. It's a very directional move. So for someone looking at this on an hourly chart, you can easily look at this and say, bullish trend, bullish trend, bullish trend. We could even take the move previous to that, which gets even a little bit more tricky, right? We take a look at this move right here, and we can actually see a violation, right? So you may be looking at this chart just in an isolated stance, right? And you're saying, okay, well, the market has been in a bearish trend, but then we double bottom down here. We come up to retest the highs, and then we violate those highs. We violate the previous bearish trend, and now we've gone bullish, right? And for someone that just isn't in the known, this can really alter your perspective on the market, right? You may be in a situation where you see this, the bearish trend has been broken, we're now bullish, and let's say you enter a trade and you're looking for some absurd target that is miles and miles away. You enter the trade, you put your money at risk, only to have the market reverse and stop you out, and then wonder, well, Akil, I thought we were in a trend. How come the trend didn't continue? Well, if you remember the higher time frame perspective, what were we higher time frame? Were we bullish? Were we bearish? We were bearish, right? And although we see a very short-term bullish move, it is just that. It is short-term. There should be no reason that we should expect that move to continue until we see our higher time frame confirm that. And that's a very good way of being safe, because although we have the violation here and we go into that bullish rotation, if we look back on the daily, has that ever occurred? Going back to this area right here, has that ever occurred here on the daily? Give me a second. There we go. Clicking candles instead of the arrows, right? So we look here on a daily. This is that bullish move. Really not too much, right? There's no real rotation here. If anything, if you look at where price action reversed at, right? If we look left from this area and kind of draw out a micro level of structure, what do we have there, right? A retracement right back into previous structure looking left, right? No surprise that price decided to come back to this level. No surprise that price decided to reverse at this level and work its way back down. Looking even lefter, you can see if we continue to grab this arrow and pull it out, what do we have? our previous new structure low, which would be the start of our kill zone. So I hope those two examples kind of clear up the importance of the bigger picture. You need to have a higher time frame, you need to have a lower time frame, and you need to use them for very specific things. That higher time frame, in the case of our example, was the daily. This is used for you to say, we are bullish, we are bearish, right? And any type of violation in structure, any type of shift in that mindset needs to occur on this time frame. We can go down to the lower time frames and we can see, hey, this is we have a bullish move, for example, but it's important that we understand that this bullish move is simply only a retracement in the bigger bearish move. And that means a few things. That can mean A, I avoid it. In no way am I looking for any type of bullish move because it's not in line with the underlying trend. Or B, if I am a trader that's looking to get involved, I'm very cautious with where I put targets. I don't want to be too greedy. Maybe I shoot for the previous level of structure. Or, as I mentioned before, maybe I just don't get involved in the move at all. So I hope this helps. In the next section, we'll kind of talk about the differences between those looking to trade the underlying trend versus looking to trade the short-term trend. And as always, please take some time, go through your charts. I always say find at least 10 examples. So mark up 10 charts and write down, or just in your mind, keep an eye on bullish trend, or not bullish trend, excuse me. In your mind, keep an eye on underlying trend, short-term trend, long-term trend, short-term trend. But in all honesty, you should be doing it more than 10 times. Do it as many times as it takes for you to feel comfortable with it. And as you go on to different courses, as you go on to live trading or joining us in the live trading room, each and every time you look at a chart, you should be running through these different perspectives in your mind. You should even be writing them down. New Zealand dollar, long-term trend bullish, short-term trend bearish. Come back your next day when you do your analysis, long-term trend still bearish, short-term trend bearish, and just see the differences that happens. I know it's an extra step that you guys need to take in writing stuff down and paying attention to your trading, but trust me, this extra step is well worth it. It will be a valuable addition for you staying on the right side of the markets. All right, so I hope you guys enjoyed that preview, and more importantly, I hope it made sense. Do me a favor, leave feedback below. Again, let me know what I can do better. Let me know what I did good. Let me know what I did bad. And just be critical. Don't just type in stuff like, Akil, you're a loser, because that doesn't help me get better. Explain why I'm a loser. And also, if you're interested, if you love this kind of long form type of content instead of my normal shorter YouTube videos, I'm going to leave a link below in this description box. Click it. It's going to take you to our latest webinar at Tier 1 Trading. We do workshops and webinars quite frequent, so make sure you're in the know about them. Some of them are still recorded and available on the platform. Some of them may be starting extremely soon, so make sure you're in the know. Yeah, so that's about it. I'm tired. I'm exhausted. I hope you guys took some value from this. And until next time, plan your trade, trade your plan. As always, hit that like button and share on your way out as well. All right, take care.